Pinakin Parekh, Executive Director, Metals and Mining in Oil and Gas. He also tracks cement for JP Morgan as an analyst. He joins us. Pinakin, it's the first time I'm interacting with you on this forum, so very warm welcome. I must say that I quite enjoy reading your reports, and your bullishness on metal stocks is something which really has been the talking point for a lot of fund managers. Pinakan, you've got a differentiated view on steel. Let's understand what your understanding of the steel cycle is. One, there is a local factor at play, which is India specific factors, and then there is a global factor at play, which involves China and US.
Sure. Thank you, Nikunj. Good morning. So basically, what our view on steel is that essentially, stocks are pricing in a very steep decline in steel prices and earnings, which at this point of time does not look likely. Second, seasonality supports steel demand and pricing in the first half of the year globally. The March and June quarters are very strong for steel demand in Europe, US, China, and India. Third, the worst of Chinese demand decline is likely behind us. What we have already seen is coking coal prices, iron ore prices, Chinese domestic steel future prices move higher. And therefore, the trade from here is going to be improving steel demand and hence improving steel prices over the next few months. Vis-a-vis, you look at what the stocks are pricing in, what investors are discounting in, and that is a disconnect where the risk reward is attractive for steel stocks at this point of time.
How should one understand the biggest moving variable which everybody is trying to understand how to assess, which is the China factor? I can look at the rate cut which the Chinese central banks today have announced and say that look, they want growth to come back. I can look at a lot of other data points which are coming from China which are indicating two slow growth points. How should one understand the China correlation?
Sure. So if you are an investor in there are two variables that you need to keep in account to China. The first is that what is the structural outlook for China in terms of supply capacity, and will the Chinese policymaker remain committed to the emission reduction footprint that they've chalked out? And if this is the case, which we believe is the case, it means that structurally steel capacity, aluminum capacity, metals capacity in China will keep on reducing. China on the margin will export less of these commodities to the world, and the world is in deficit. The second is the near term, the next 12 months or so. What happened in fourth quarter was a very, very steep decline that we have not seen for the past decade or so. Steel demand fell between 20 and 25%. From here, very clearly, if you look at all the key events which have happened in China in terms of RRR cut, interest rate cuts, if I look at the outlook for all JP Morgan analysts in China, it is for an improvement in demand and the economy sequentially. So Q1 should be better than Q4, Q2 should be better than Q1. And that is what is important for metal prices and metal stocks. If incrementally demand improves, which supports incremental change in prices versus stocks which are pricing in a decline, that is what makes the risk reward attractive.
I like to encourage your thoughts on something which again is my personal observation, which is that if I look at steel companies, we always talk about cycles in China. But the real story for Indian steel companies could be that they're generating a lot of cash and they are also returning a lot of debt back. So what changes? Because if debt goes down, I'm sure markets would like to start pricing some of the steel companies, let's say a Tata Steel or a JSW Steel, very, very differently.
Sure. So, I mean, no stock specific comments, but broadly, if you look at it, few things are happening at this point of time. Steel companies reported their highest ever EBITDA per ton sometime in the first quarter last year or first quarter. Since then, earnings to be plateauing at market levels versus at any point past. Historic, whenever steel prices globally would fall, you would have HRC going below $400 a ton. Now, if you look at 2021, the lowest point of the year was in the December quarter where regional HRC prices did not go below $800 a ton. Now, what it means is that earnings are plateauing at very high levels, which translates into very, very strong free cash flow generation. And this in turn allows the companies to reduce debt very, very sharply. But we are going to reach a point very soon in this year where the companies would have reduced as much debt as they can. And they would like to do capex. And we see companies across metals and mining, oil and gas, cement, starting on a big capex cycle for at least for those companies, but it will come on the back of a much improved balance sheets. Debt is probably at the lowest we have seen in more than a decade or so. And this would force markets eventually to re-rate these industries vis-a-vis the multiples that they are assigning them right now.
What is a better bet? A company which is completely integrated, which has access to ore and coal, or the front end companies which are doing value addition, they may not be integrated, but then they will get advantage of on the export front, and they are large converters.
Sure. So, I mean, more than the integration vis-a-vis non-integration, what we would look at is, how are companies' cash flows through cycle. Obviously, companies which are integrated tend to have better cash flows through cycle simply because they get the advantage of raw materials. But it's also about the, how do you deploy capital? Are you reducing debt? Are you adding, costs? Capex competitively. Generally, what happens is that markets. Tends to be an industry where stocks tend to move together. So if you see steel prices stabilizing, steel companies across the board will benefit in terms of better earnings.
Good morning, Mr. Parekh. This is Nayantara. Like Nikunj, I also really enjoyed reading your report, and we've talked about steel. I have one question as far as aluminium goes, and this is for the benefit of our viewers, where in your report, you also talk about Indian aluminium companies from a Hindalco to a Nalco to a Vedanta underperforming the global peers. Do you think that can change in 2022?
Sure. Good morning, Nayantara. So if you look at it, if you take a step back, it's across the board. Indian metals and mining, steel, aluminum, pure play miners have underperformed the global peers, especially in the last 3 months. And this could probably be attributed more to the foreign fund selling rather than any company specific factors per se. Eventually, our view is that the price does not last very long strong. If prices remain very strong, aluminum companies track those prices, and if you have global aluminum companies doing well, the Indian companies cannot, underperform to the extent that they have done so. So our sense is it's more driven by, an India sell-off which impacted the performance rather than any company or industry-specific issue in India.
So, I'm going to ask this question on behalf of a lot of our viewers. Very often when fund managers join us or analysts join us, from the Indian stock market's perspective, they talk about they prefer aluminum companies to steel companies, especially maybe because of the run-up in the steel prices that we've seen. Would you folks hold the same view?
So, if structurally our view is that aluminum and steel both are essentially plays on China's decarbonization. If China continues to decarbonize, China is the largest exporter of these two commodities to the world. Their exports will reduce, and that will support steel and aluminum prices. In the near term, seasonality tends to favor steel at this point of time. Steel demand will improve post the Chinese New Year, and vis-a-vis in Europe, where the peak winter shortage of gas will recede. So to that extent, in the near term, A, given the steel stocks underperformance, B, given that the Chinese demand improves post-Lunar New Year, tends to put steel in a better risk-reward framework. But structurally, both steel and aluminum at the end of the day are proxies on China's decarbonization.
I want to go back to that initial comment of yours, because that in a sense is the most important assessment which our viewers want. Metal is in an uptrend, and China is not going to export steel. It's something which is been in headline news. But when you say that markets are pricing in too much of a decline in the steel stock and there is scope for metal stocks to give positive returns, how are you assessing that? How are you assessing that markets are bearish and the outlook will not be that bearish?
Sure. So if you look at all the steel stocks have long trading histories. If you take the average multiple and you assume that this is what the stock's trading at right now, it effectively implies a very steep drop from spot earnings. If you look at consensus earnings estimates for F23, vis-a-vis what the companies will report in the near term, it also is building in a very sharp decline. So consensus earnings estimates are building in a decline. The stock based on average historical multiple is building in a decline. If you take that framework and look at what is happening in the steel market at this point of time, sequentially, Chinese data points have stopped deteriorating. They are not yet improving, but they have stopped falling. We have heard news flow about European steel prices inching higher. Iron ore has moved more than 40%. That suggests that steel from here should move higher rather than low. And vis-a-vis stocks which are pricing in a big decline. And that is where the disconnect is.
Can high energy prices, and we've seen evidence of that, when coal prices or coke prices, they went up in the month of November and December, steel companies were struggling. Can they really pour cold water? Can supply chain disruption pour cold water on what bullish assumptions you have?
Sure. So one is this, a longer term trend. Higher prices do not move in isolation. So you will have the general commodity basket do well. If you have higher oil, higher coal, you will also have higher metals prices. In the near term, a lot of it depends on seasonality. So you do tend to have dislocations in terms of coking coal supply, in terms of coal supply between the October and Feb months because of the cyclone season in Australia. But that on the margin will fade. As the supply disruptions from seasonality reduces, you should have more normal pricing. Yes, you will have lead and lag in terms of raw material prices and the end product prices because both tend to have different seasonalities. So while the seasonality would be supportive for more supply of coal, it will also be supportive for more steel demand. So at this point of time versus the last 1 or 2 quarters, it is beneficial versus being negative.
If the Build America program goes through what the US administration is trying to achieve from it, and if I look at a scenario where China is not going to be a large exporter of steel, then can US replace China both in terms of demand and being the guzzler? And if yes, what does that mean for Indian steel companies?
So the US steel demand is a tenth of China's at this point of time. On the margin, what my colleagues in JP Morgan North America have talked about is that any infrastructure spending will push up metals demand, will push up commodities demand across the board. But clearly the base itself is very, very small. But what we have to understand is that if you look at steel and aluminum, these two commodities, if you take China out of the equation, the world ex-China is in deficit or in balance. And China is a big supplier to the rest of the world. So if you have rest of the world demand which continues to improve and Chinese supply reduces, effectively the marginal price increases for new capacity to get added. And that is positive for example, companies which are on the low end of the cost curve. And especially all the Indian companies are at the lower end of the cost curve for these commodities.
Okay, Mr. Parekh, it's been an absolute pleasure having you on the channel and for breaking it down for us. We've seen the entire metal pack regain its luster, so it's great to have the fundamentals and the basic blocks in place. Really appreciate you taking your time out.
Thank you.